What if I told you there's a way to protect your family's future without spending a fortune on insurance? It sounds like a no brainer, right? Big protection, smaller costs. That's exactly what term life insurance offers. But here's a catch: while it's simple and affordable, if you don't pick the right plan or the right coverage, you could end up uninsured or paying for things you don't need. So, in this video, let's break down what term life insurance really is, the features you should actually care about, how it compares to whole life insurance, and how to choose the right insurance plan. Hi, I'm Fer from dollarbureau, a personal finance platform that talks about insurance, investments, and financial planning. Let's start with what is term life insurance. Think of term life insurance as a pure protection policy. It pays your loved ones a lump sum if you pass away, are diagnosed with a terminal illness, or become totally and permanently disabled during the policy period. This period, or the term, could be 10, 20, or 30 years, up to 65, 70, or 75 years old, or even up to 99 depending on the plan you pick. Apart from the term to 99 years old policy, is not meant to last forever or build wealth. Instead, it's designed to protect your family during the years when they rely on you the most. That's all. You can add riders like critical illness or early critical illness coverage if you want that extra protection against health risk. Now that you know what it is, let's explore the different types of term life insurance available in Singapore. The first type is the level term insurance. This is the most common. Your coverage and premiums stay fixed throughout the policy. Simple and predictable. Number two is increasing term insurance. Here, your coverage goes up over time, usually to keep up with inflation. Premium also rises as well. The next one is decreasing term insurance. Coverage reduces as time goes by, often tied to a mortgage or a loan balance. It's cheaper but only makes sense if you're covering a specific debt. The next one is term to 99, which covers you until the age of 99. It's like lifelong protection but without the cash value of whole life insurance, and premiums can also be much lower. And there's also group term insurance, often offered by employers. It's affordable, sometimes subsidized, but usually ends when you leave the company. And of course, the Dependents Protection Scheme, also known as DPS, which is the government's basic term insurance for Singapore citizens and PRs, covering you up to the age 65. Here's an actionable takeaway: match the type of plan to your needs. Covering a mortgage, a decreasing term plan could be enough. One affordable long term cover, term to 99, might be better. Of course, the type of plan is only half the story. The features inside the policy can make just as big a difference. When comparing policies, look out for these useful features. Number one, convertibility. Lets you switch your term plan into a whole life plan later without medical checks. Good if your needs change. Next is renewability, which allows you to extend your policy when the term ends. Premiums start low but will be higher every time you renew it. Third is the increasing options. Some plans let you increase coverage after life events like marriage or having kids without new underwriting. This can be important especially if you suddenly become uninsurable but need more coverage. There are also riders. Critical illness or early critical illness riders provide payouts if you are diagnosed, giving financial support when you need it most. Don't just go for the cheapest plan. Compare features because they could save you money and stress down the line. Now, you might be wondering, how does term life compare to whole life insurance? Here's the quick way to think about it. Term life insurance is pure protection with no cash value. It's cheaper and flexible but ends once the term is up. Whole life insurance combines protection with savings. It lasts for life, builds cash value, and can even pay bonuses. But premiums are much, much higher. If your main goal is affordable protection during key years, term life is usually enough. If you want lifelong coverage for life insurance and also for ECICI if you have a rider, a whole life might be worth the higher cost, especially since there's a cash value as well. But if a whole life plan gives me coverage for my entire life and also gives me back some money, why do so many people still choose term life over alternatives? Let's look at the advantages. There are three main reasons. First is affordability. Term life gives you the most coverage per dollar. Second, flexibility. You can choose a term plan that matches your financial obligations, like 20 years for a mortgage or 25 years until your kids graduate. Third is temporary coverage. It's designed to cover you when you're most financially vulnerable, not forever. Remember, the point of life insurance is to replace your income for your family when you pass away. The question to ask is, will your family depend on you forever? Will you be working even past retirement? Do you even need ECI and CI forever? These are some considerations to take note of. But who actually benefits the most from term life insurance? Well, if you are budget conscious, term life makes sense because you get high coverage at a lower cost. If you're young and just starting work, you can lock in coverage now while premiums are still low. If you are married with a mortgage, a term plan that matches your loan ensures your family won't be burdened if something happens to you. If you have kids, you can pick a term long enough to see them through school and into independence. And if you're a buy term, invest the rest kind of person, the money you save on premiums can go straight into investments while keeping your loved ones protected. Alright, but how much coverage do you actually need to make all this work? Here's a practical rule of thumb. Aim for coverage that's around 9 to 10 times of your annual income. But that's just a starting point and just a guideline. A more precise method is to use your expenses, multiply that by the number of years of your longest dependency, and factor in yearly inflation. So think about your debts, your kids' education costs, your spouse's needs, and the assets you already have. If your child is 2 years old and will depend on you until they are in uni, so that's usually 25 for boys and 23 for girls, then you will need coverage of up to 25 years of your expenses. Here's a tip: don't guess, use an insurance coverage calculator to get a precise number based on your actual situation. Our financial toolkit lets you do this easily. First, you fill in your monthly and annual cash flow in your cash flow statement, then tally up your assets and liabilities in your statement as well. This will form the basis of coverage you will need. Then key in all your insurance policies in one place for easier tracking. Once done, the protection tab will show you how much coverage you need. For example, if you are spending $2,000 per month and are providing for your child until they are 25, with a 2.5% inflation rate, you'll need about 1.1 million in death coverage. But after factoring any assets, current life insurance coverage, you will see how much shortfall you have, and in this scenario, it's only about $500,000. This makes sure that you get exactly what you need so that you don't overspend on insurance and put back more into your pocket. I'll link to our financial toolkit in the description below. Once you've got an idea of the amount, the next step is choosing the right plan. Here's a simple 3-step process. Step 1, identify your needs. Are you covering loans, your children's future, or your spouse's retirement? Do you need ECICI coverage on top of the life insurance coverage? Properly understanding your needs is a key step before shortlisting which term plans are good for you. Step 2, balance premiums with coverage. Cheap is good, but not if your family ends up underinsured. Also think if you're looking for other features like convertibility. While some features are good to have, some might be unnecessary. Step 3 is to seek advice. There are a ton of options out there. A licensed financial advisor can help you compare and customize the right plan. And before we wrap up, let's quickly clear a couple of common questions people usually ask about term life insurance. Number 1, do term insurance plans cover illnesses or total and permanent disability? Yes, many do actually, either as part of the base policy or through riders. Be sure to always check the policy wordings. Number 2, can seniors get term life insurance? Yes, but take note that there are maximum entry ages for policies depending on the insurer. Also take note that the older you are, the fewer options are available and premiums are usually much higher. Okay, with that cleared up, let's tie everything together. Should you get term life insurance? If you are looking for affordable protection during the years your family relies on you, then yes, it's one of the best ways to secure their financial future without overspending. It's not meant to be forever and it's not meant to grow your wealth, but for many Singaporeans, it's the most practical choice. If you're unsure about the right amount or which riders to add, don't leave it to chance. Talk to a trusted financial advisor. I'll leave a link in the description below if you'd like to connect with one of our financial advisors. And if you found this video helpful, don't forget to like, share, and subscribe for more simple, practical financial tips. Thanks for watching. I'll see you in the next video.